Well, thank you so much for having me here today. And what I'm going to dive into is, how to trade extreme market uncertainty using low risk, high return option strategies. So we're going to look at two really unique strategies that really offer you some great returns, but also kind of keep your capital at risk very, very small. And those are the butterfly and long condor. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice, should not be construed as a recommendation. So the butterfly and the long condors, they're very dynamic, and these two type strategies can be traded for a variety of different reasons with different goals in mind. So in other words, once you learn how to use the butterfly and condor, you're going to be covered for both your offense and your defense in your trading, so your goals and protection. Now, these two strategies can work no matter, regardless what the market is doing, as far as it could be an uptrend, downtrend, or sideways market action. So they're going to take the unsettling guesswork out of your trading. They'll eliminate the stress of having to always be just perfect on a stock's direction or overall market. Really helps to eliminate the time decay expense that's going to be encountered from decaying long options. And they can be structured for a very low cost or low capital at risk. So it makes it great for extreme market conditions where you want to limit that risk. But the other great thing is your returns can be anywhere from 10 to 1 or higher. So that makes them ideal for any market condition, but especially when we get into extreme volatility. So the butterfly and long condor, they can also be used for hedging when you mess things up. So when you need something for a fast, low-cost way to cover your what, my go-to kind of hedging technique is to use the butterfly or the condor. I've literally found no other strategy that comes close to these two as far as a way to set up a hedge, really quick and pronto. So by this hedging, what you're going to do is you're going to construct either a butterfly or long condor around a trade strike that is under pressure from another core trade, such as it could be a credit spread or a debit spread. So it's the best way I've found really to immediately neutralize and lower your risk. So if you've done credit spreads in the past, you probably know what I'm talking about. Sometimes if they get through your short strike, you're pretty much done. But by using a butterfly defense, we can neutralize that before that happens. And this was one of my members, Pam. She said, "I wish I knew how to use this hedging defense before I lost so much money doing credit spreads." So that's the real truth about it. So when you do credit spreads, you can roll it up and out, but sometimes I find it a lot better just to convert it to a butterfly. And we'll talk about that a little bit more here in just a few minutes. So when we look at the butterfly, they're very kind of simplistic construction. So you're basically using two vertical spreads together. So in this example, let's say you're long a call and you're short a call. Okay, so this is a call debit spread. So your risk here would be your debit cost of $300. So that's your risk. And then if you go to close above that short strike of your spread, that's where you make your max profit. So here you can see this would be like going long the 1010, long call and short that 1020. So you've got a spread width of $10. For one option contract, that's $1,000. Your risk is your debit paid at $300. So you've got a potential here for a $700 profit. So good positive risk return. But if we wanted to reduce this risk really quick, we could do that a number of different ways. But one, we could convert it quickly to a butterfly. So I could sell a credit spread against this, and then all of a sudden I've created this butterfly defense where I'm short that call, long a call, and now I've got this spread converted to a butterfly, and I can just sit back and I've got the opportunity to make an even much bigger potential return. So now I've reduced my risk down to $100. And if I do get a pin, what we call this is the top of the tent right here, we got a pin into expiration right there. This spread profit would be up to a profit of $900 or 900% return. So I went from that potential profit of 700 to 900, but I've also reduced my risk to 100, and I've increased my return in this example up to 900%. So it's kind of a win-win situation if you get it, where it's starting to pin in that direction. So that's kind of the construction there when we look at the butterfly. Now, the other kind of off-take of this is what we call the long condor, not to be confused with the iron condor. So this is combining two vertical spreads. So in this situation, instead of converting to the butterfly, using that short strike where we were with the call debit spread right here, we're going to widen out the profit zone. So we're going to make this a little wider to give us a bigger zone of profit. So in this example, I'd be long that call there, short the call, but I'm going to widen out my other call credit spread to here and be long that. All right, so that's the condor, long condor. So we can do this with calls or puts. If we think the market's moving up, I'll use, long call condor. If I think it's going to move down, I'll use a long put condor. So really flexible, great way to trade the markets. And what I really like about this one is when we get what I call a kind of a consolidation volatility squeeze pattern, which we'll look at here in a minute. But let's say we're consolidating really tightly, and we want to keep a really low, super low risk trade on. So what I'll do is when we break out either up or break down, I'll do this trade a lot of times using this condor structure to keep my risk low, but also give me a good positive returns of anywhere from 1.5 to maybe 3 to 1 return on my risk. So it's a great strategy for that. Now, the crucial concept that really is important for these types of strategy really comes down to knowing and understanding how to take advantage of time decay or theta, and what the effect that theta decay or time decay will have on the price of your options. So let's take a quick kind of review of this. So what this does is when we look at theta, what it does, it tells us how much an option price is going to go down over time. Okay, so this is the rate of time decay of your stock option. And by expiration, theta is going to go to 0. So when we do the butterfly or condor, we have what I call the additional sell side component of the spread, which takes in advantage of selling time and volatility. So we get that time decay benefit in our favor. So looking at this kind of example, let's say we think that XYZ is a trade at 45. And we're looking at for just a small move down to 43. So with this one, let's say I could do what I typically will do with the butterfly. I'll use my target, and this one the price target's 43. I'll use that as kind of the body of the butterfly. So we'd be looking for a downside move. So I'd buy the 44 put. That's going to cost, say, 238, that debit cost there. Then I'm going to sell the 43 put below it, $1.67, bringing in that credit. Then I'm going to sell it again and buy the put below it, the 42. So now I've done a dollar-wide butterfly, and my total risk on this is going to be $10. So I've got the debit cost there of 238, $1.06, and then I've sold that twice. So my debit cost is 10 cents or $10 per option contract. So that's the maximum risk I have on the trade. Now, if we go out at the top of the 10th, the max potential profit is going to be my spread width of 43 less 42, $1, less the cost of the trade of 10 cents. Then, that's 90 cents, or for an option contract, a butterfly would be $90. So if I got to move here, pin into the, expiration at right there at that 42 or 43 strike, it's going to be up $900. So I risk $1 to make 9. So that's a 900% return. So that's kind of the concept and what we're looking at to, take advantage of with this type of spread. Now, one major goal, for every trader, in my opinion, is to select trades that are going to be based on what's going to provide you the most consistent positive returns with low defined risk, and not always that greatest return. And one of the best ways then to achieve this goal is to be aware of the different option strategies that are available to you, understand how they work, and then select the one that's going to be best suited for the market environment you're trading and your specific trading goals. So these two spreads, the butterfly and condor, are two that are perfect for anyone's option trading book or trading book in general, because you can do this with one option contract, or you can do thousands of these. I mean, I've done literally thousands of butterflies in the past. So these are good for futures contracts or anything you want. But when we look at the butterfly, there's a kind of what I call the butterfly family. So there are multiple different variations, and they're all kind of having that selling time and volatility component to them. So we have what we call the long call or put butterfly. We have kind of a variation off that called the broken wing or skip strike butterfly, where we use calls or puts. We've got the ninja unbalanced butterfly, the iron butterfly, and another really cool one is what I call the lotto butterfly. Then we have hedging the fence using the butterflies, and the long condor spread, which kind of the cousin for the butterfly. So let's take a look at a few examples here of how these variations kind of can work for you. So the one that we typically do the most will be wide wing butterflies, because these will provide us a wider profit zone. They're going to be structured for defined risk, great for hedging, great for targeted directional swing trades, great for pinning trades, really great when we get in high volatility markets, because when we reduce our risk, we also take advantage of implied volatility going up when we're selling that implied volatility with the butterfly. Also great for high price stocks. We can make a really cheap entry into a stock that we want that could be over $1,000 wide. So typically, I'll show you an example of Amazon when it was trading at those high levels. We could do a butterfly versus having to put out a lot of capital for that. Trade duration usually can be a day to 2 weeks. No time decay, always a positive theta, returns of 2 to 1 up to 20 to 1 sometimes. So here's a good example of Amazon. Now, this was back when it was trading over $1,000 per share. So by using the butterfly, we could trade a really great upside trade with the minimal cost. So in this example, Amazon was trading back here at 1782. So we were looking for a move up to about this 1830 strike right there. It had been consolidating. So we wanted to take a directional move to the upside. But if we bought, let's say we convert, we bought 100 shares of Amazon, relative to like one option contract, that'd be over $178,000 to buy those 100 shares. So that's a lot of money, a lot of potential risk. But in this example, what we did was we did a butterfly targeting that 1830. So that was the body. So what we did, we went out and bought the 1820 call, sold the 1830, sold the 1830, bought the 1840. So we had this $10 wide call butterfly, so a $1,000 wide spread. The cost of the trade was then 80 cents, 80 bucks. That was it, versus if you'd bought the shares, you're over 178,000. Now we have the potential spread with less the cost of the trade in this to make $920 per spread. That would be over 1,100% return. So risking $1 to make 11.5. So that's one of the great benefits. But then the other really cool part about this trade is that we do with time decay and volatility collapse, this thing at the end of the day ended up making 4 times more than what it started out with. So this was going into option expiration in the morning of the expiration. So at that point, this trade was up $150. Okay, so it was trading right here at 1836. All right, so all that black area is potentially profit from the time that's left in the options in the butterfly and implied volatility. So later in the day, about 3 hours later, this thing now was up 4 times more in profit. So you can see it was trading up to $614 per spread. Okay, so it was up here now at 614. So this was now up to 614 per spread, or 769% return, versus, let's say you just bought the stock, you'd be up 2.69. And you can see how that increased from the morning. In the morning, it was trading right here. It was up 150 bucks, 187% return. And on the same day, just a few hours later, having that time decay sucked out and volatility sucked out, you can see just very little left there in the top of this tent. So now it was up to 769% return. So that's a really great, cool thing about it. Now, this is the fun part too. We do what we call these lotto trades. So this was my lotto ticket trade on a butterfly. And this went up from one of my members, and he kind of put it really put it straight. He said, the butterfly strategy is one of my favorites. It's the big winners that eventually make the difference in any trading account. With all the so-called low option strategies or low risk option strategies being sold to the public, an account without the potential to hit that one big one once in a while not betting the farm is a slow ride up a long hill. But this strategy is easy as ABC. So here's one we did not too long ago. This was on Tesla. And so we were looking for Tesla for what we call a pinning trade and expiration. We were looking for a pin at the $200 strike. All right, so this was on the 8th of February. It was trading at 189.35, and we were looking out here to the 200 strike right here. So this one was an amazing trade that we set up. This was what alert trade that we set up in our room. I've got alert service that was, sent this out as well. So what we did here, we were targeting that $200 strike for expiration. So we went out and bought the 197.5, 200, then sold the 200, bought the 202.5. So we had this spread width of $2.50. We had the butterfly on. So we had a spread width of 2.5 less our cost of the trade, 12 cents. That was all the cost and the risk. Now, the potential then, if it went out at our 200 strike, was for $238 per spread. That's a 1,980% return. So these are possible. You might probably think somebody said, hey, I just made a 1,500% return. You think you're probably lying, but this is actually, what you can do with this strategy. So here it was going out later in the day. So it was trading right here on the 16th expiration day. It was trading right here at $200. And so at that point in time, this was about 2:30. Expiration was at 3. It was trading right there. So it was up $231 per spread on that risk of 12 bucks. So this was up 1,925% return. So that was within 8 days. So that's why I call it kind of a lotto trade. So all we had to do was we had a risk of 12 bucks. That's a cup of coffee at Starbucks, and potential to make much more than that. So that was it towards the end of the day, and here's where it pinned exactly at 200. So this was actually pinned at 200. So that was $238 at the close, up 1,983% return. So pretty amazing trade. Now this is an example of what we call the long call condor. This was a long condor, but using calls for directional move to the upside, and this was on Abbott Labs. So this is an example of us talking about earlier. We have this kind of really tight volatility squeeze going on where it's consolidating, looking to break out either up or down. Now I use my momentum indicators to give me directional potential, and we had what I call cycle reversal, positive momentum. So we're looking for this to break to the upside. So that's where we're looking for it. So when it started breaking these highs, we set up a long call condor to keep reduce the risk, keep it really low, but participate in the upside move with a good return. So we set up this long call condor, and basically it was structured being long the 116 call, short the 118 call as a debit spread, and then short against it the 119, 121. So we can leg in or do this all at once. So with this spread, we had this spread on, it was a $2 wide spread, $200. Now the cost of the trade was 67 cents, 67 bucks or $67. And if we went out inside our condor in this area here, we keep the full amount of the profit, which would be $133, 198% return. Now this will also give us a positive theta, which is another thing that I love about it. So that's a big benefit there. So here's exactly where it went out. We took the trade off, and it worked out really well, going out right about in here. So this was, an expiration. This actually was the day before expiration on the Thursday. So locked in the profit there. So it went from 67 cents or $67. Now it's trading at 178. So there was our profit of 111 or 166% return. So another really good example, and this was another trade that we did through my alert service. So some really cool trades. Now, the other thing that's great with these types of trades is we can, use it for a hedge. We can leg in, leg out. So, doing like Abbott, we could start out doing a call debit spread, then add the credit spread to it at another time. And this is something we just did here today. We did a trade. I'll just show you real quick. On the Dow, DOW, let me pull that up and I'll show you what we did here today. So we were looking at this was just something current. We were looking at this trade. So we went long with a debit spread early in the morning on DOW, and then adjusted it to butterfly a little bit later in the day. So currently we've got, and this is one that legged into, so started out with this trade here, long the 17 May 58.60 call debit spread, 77 bucks, and then when it was running up, sold the 17 May 60.62 against it, so converted that to a butterfly. So I had the call debit spread on, potential profit 123, but then added the credit spread. See, this has a negative theta, minus 44. Added that credit spread, gave us a positive theta, reduced our risk by 30 bucks. Now we've got the trade at $47 of risk. If we get a move in there towards 60 bucks, towards next Friday, this will be up about 150 bucks on that risk of 47. So a really great way to do that. So that's a kind of a, what you could look to look at. And if you'd like to master these kind of high reward, low risk strategies that work in any market environment, I've got a really special, nice offer to you here for today for the festival. And if you want to take advantage of that, use this link here that was just put up. You should be able to click on it and it'll pull up a payment link. And with this, you're going to get 5 enrollment bonuses. So the full course package is $985, but it's yours today for $197. So just use that link that he just Dave just pulled up there. So powercycletrading.com/FEST small cap. And what you're going to get here is this course. I did this course, finished this course back in March, and this is on my website now for $397. But if you sign up today, you're going to get the course. Plus, you're going to get a live follow-up Q&A. We'll send you out a link for that. So this will be live and recorded, so you can come in and ask any questions. Then I'm going to also give you a 30-day trial membership to my trading club. So this is $97. You can start this whenever you want. And then if you want to renew, I've got different packages, but you could renew at $97 or you could do an annual membership. We've got a lot of different rates that we have. And then you're also going to get how the pros use the Greeks. So it's really another option guide. And on my option strategy manifesto, this will be 15 different option strategies that kind of guide you through how they work in my power tool guide. So you're going to get all these additional bonuses. So for everything here today, $197. And let's kind of go through what you're going to receive here. And then if I have time, I'll be happy to answer any questions. So completed this course back in March. So it's a 6-hour plus recorded course in modules, 30 minutes or less. Plus, you'll get the training manual, over 400 pages there. So part 1 starts out with the option Greeks, which Greeks are vital for the butterfly and condor, how they affect the butterfly condor, like delta, gamma, theta, things like that. And then theta decay, the impact on the butterfly condor, volatility and the importance of how volatility crush, works, for the benefit of butterfly and condor. And then how option pricing works to see what the effects of time decay and volatility. So you understand option pricing to understand how these two structures work. And then I'll get into part of the course. We'll cover what I call my Fibonacci price target mapping and standard deviation for your price targets. So when we're looking for targets, this is kind of what I use, and you're going to get that in the course. Guide you through that in the course, what that is and how it works. And then part 2, we get into all the different variations. We'll go through what really makes them work. So I'll go through how, why, and when to use every variation with examples and why we would do that. So you're going to learn how to do the call or put butterfly, the wide wing butterfly, the broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, that lotto butterfly, vacation butterfly, and long condor. So you're going to get through every variation of these in the course, examples of how they're done and when to use them. So you'll understand which one you might like best. And then we'll get into what are the best time frames, for the butterfly condors to capitalize on them, with stocks or ETFs or index options or futures. You can use any kind of underlying security for butterflies or condors. And then how do you structure those setups where you get that 10 to 1 or higher? So for example, Tesla was actually almost 20 to 1. And so, on a risk of $12. And so then how do you profit from option volatility crush and theta decay? Then how to trade the monthly option expiration. So this is a really fun thing to do. And we've got monthly coming up next week. So that's kind of what we're focused on right now, actually, in our trading room. So, 12 times a year, we're going to get these monthly option expirations, and they present us a great way to generate some really big returns on low capital at risk. Okay, so what's called option pinning. Okay, so that's covered in the course, and how to define what is a pin trade, how to look for them, how to identify them, and put them on. And so then how, why, and when to use the long condor spread in your trading for your directional trades, very controlled risk trade, and when to do that. So these are all covered. And then I have part 3 is your progression of hedging. So I'm going to go through in this part how to hedge, using the butterfly and condor at core position, or how to defend a vertical debit spread or credit spread. And so then goes through a checklist of when to put them on, how to take it off, execution, adjustment, management. And then I go have a resource page or chapter to look at assignment risk and expiration risk in a trading library. So really great comprehensive package for you. So here's just Pam again. She said, excellent class, Larry, as usual. You under promise and over deliver. I wish I'd known how to do this hedging before I lost so much money doing credit spreads. So that's what you're going to get. Now, bonus one is the trading club. So you're going to get a 30-day trial membership. You can start this, after you complete the course or whenever. And so then with this, you're going to get the benefit. You can come in my trading room open from 9:30 to 10:30, Monday through Friday. So if you've got a question on any trades you're doing or want to see what we're doing, come on in. Do a daily video newsletter every day, and then these are archived. We do a weekly Q&A every week, and you'll get additional trading educational material in your vault, and 60% off of every course and software on my website. So you'll get that. Bonus two, we'll do a follow-up Q&A. Okay, this will be live and recorded. We'll send you the link for that. Bonus three, how the pros use the Greek. So this is just another little small option course. 60-page guide and videos on the Greeks, delta, gamma, theta, standard deviation. So really good course on that, abbreviated kind of course. And then 15 option strategy guides. You're going to get that. What's a back ratio spread? I'll tell you the trade construction, when to use. So a lot of great stuff there. And this is a printout you can put on your desk, my Greek power tool guide. So you can put it on your desk. What is delta, gamma, theta? So that's everything there, and use that link again, powercycletrading.com /FEST, and sign up. And I look forward to working with you guys and gals in the future.